If your emergency fund is sitting in a regular savings account, your money may be earning almost nothing, even though safer accounts with higher interest are widely available. That matters because emergency funds are usually large enough that small percentage differences become real money. An emergency fund is money set aside for things you didn't plan for: a car repair, a medical bill, losing a job, emergency travel, a broken appliance. The point is not to get rich from it. The point is to have cash ready when life gets expensive unexpectedly. That's also why emergency funds are different from investments. Investments, like stocks, are meant for long-term growth. They can go up a lot over time, but they can also fall sharply in bad markets. If you invest your emergency fund and the market drops right when you need the money, you could be forced to sell at a loss. An emergency fund is supposed to stay stable and accessible. So where does the missing out on interest part come in? A lot of traditional savings accounts at large banks still pay extremely low interest rates, sometimes close to zero. Meanwhile, many high-yield savings accounts, often called HYSAs, pay dramatically more. Here's a simple example. Suppose you keep $10,000 in your emergency fund. If your regular savings account pays 0.05% interest, you'd earn about $5 over a year. If a high-yield savings account pays 4%, that same $10,000 could earn around $400 over a year. That's roughly a $395 difference for money you were already planning to keep in cash anyway. Naturally, the next question is, what's the catch? People hear higher interest and assume it must mean higher risk, but a high-yield savings account is not the stock market. Your balance does not swing up and down with market prices. You are not buying shares of a company. If stocks crash tomorrow, your savings account balance does not suddenly fall with them. Most high-yield savings accounts are offered by FDIC-insured banks or NCUA-insured credit unions. In general, deposits are protected up to insurance limits, which are typically $250,000 per depositor, per institution, per account category. So the core trade-off is not really about market risk. It's about balancing three things: safety, accessibility, and interest earned. Traditional savings accounts are usually very safe and very accessible, but often pay very little interest. High-yield savings accounts aim to keep the same basic safety while paying more interest. The main compromise is sometimes access speed. Many high-yield accounts are online-based. If you need to transfer money to your checking account, it may take 1 to 3 business days depending on the banks involved. For some emergencies, that delay may not matter. For others, it could. That's why many people use a tiered setup. They keep a smaller amount in checking or a local savings account for immediate access, maybe enough for a few days of urgent expenses. Then they keep the larger emergency fund balance in a high-yield savings account where it can earn more interest. That setup gives you both fast access and better returns on the majority of the money. So why can online banks afford to pay more? Usually because they have lower operating costs. Fewer physical branches means lower overhead, which allows them to pass more interest to customers. There are still a few things to watch for. Rates can change over time. Interest earned is usually taxable. Some accounts have minimum balances, transfer limits, or promotional rates that later drop. So before moving money, check the account terms carefully. A practical approach is simple. Decide how much you want in your emergency fund, keep a small immediate access buffer, open an insured high-yield savings account, test transfers before moving everything, then automate contributions if possible. An emergency fund is meant to protect you, but that doesn't mean it has to earn almost nothing while it waits for life's surprises.